Preparing for FP&A Analyst at DISH interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A do, and how would you add value as an analyst at DISH? FP&A connects operating activity to financial decisions. At DISH, I would translate subscriber trends, ARPU, churn, wireless growth, programming costs, and network investment into forecasts, budgets, and management insights. The role is not simply reporting results. It explains why performance changed, identifies risks and opportunities, and supports resource allocation. I would partner with accounting, operations, sales, and network teams, then communicate conclusions clearly to leadership with actionable recommendations. While answering, focus on connecting operating metrics to financial outcomes, supporting budgeting and forecasting, explaining performance changes, partnering with business teams, and turning analysis into practical management recommendations. Question 2. What is the difference between a budget and a forecast? Budgeting sets an approved financial plan, while forecasting updates our best estimate of what will happen. I would build the DISH budget from subscriber volumes, pricing, churn, programming expense, sales activity, headcount, and network investment. During the year, I would refresh assumptions using actual performance and operational guidance. Comparing budget, forecast, and actuals helps management distinguish planning gaps from execution issues and make timely resource decisions. Make sure to cover that budgets establish an approved plan, forecasts update expectations, variances compare actuals with both benchmarks, and assumptions should change when operational evidence changes. Question 3. How do the three financial statements connect? The income statement measures profitability, the balance sheet shows resources and obligations, and the cash flow statement explains changes in cash. Net income flows into retained earnings and starts operating cash flow. Capital expenditures increase property and equipment while reducing cash, and debt financing increases both liabilities and cash. I use these connections to ensure an operating forecast produces a coherent financial model rather than isolated revenue and expense schedules. In your answer, explain income statement profitability, balance sheet changes, cash flow reconciliation, retained earnings, working capital, capital expenditures, and why an FP&A analyst must understand the full linkage. Question 4. What revenue drivers would you monitor for a business like DISH? I would separate revenue into customer volume, pricing, and mix. For pay TV, key drivers include ending subscribers, gross additions, disconnects, churn, and ARPU. For wireless, I would also monitor net additions, device financing, plan adoption, and promotional effects. I would reconcile the operational build to reported revenue, investigate changes by product and period, and distinguish temporary promotions from sustainable pricing trends before updating the forecast. Be sure to mention subscriber counts, gross additions, disconnects, churn, ARPU, promotional pricing, wireless adoption, customer mix, and the distinction between volume, price, and mix effects. Question 5. How would you analyze subscriber churn and its financial impact? I would begin by validating the churn definition, period, customer base, and source data. Then I would analyze churn by product, tenure, geography, channel, and customer cohort to identify the underlying drivers. Financially, higher churn reduces recurring revenue and may increase acquisition or retention spending. I would model the effect on subscribers, ARPU, EBITDA, and cash flow, then recommend targeted actions instead of applying one broad assumption. Focus on calculating churn consistently, identifying customer cohorts and causes, linking churn to revenue and acquisition costs, separating gross additions from retention, and quantifying forecast implications. Question 6. Walk me through how you would perform a monthly variance analysis. I would first validate actuals and compare them with budget, prior forecast, and prior year. Next, I would rank material variances, decompose revenue into volume, price, and mix, and separate timing items from recurring issues. I would meet the responsible operators to confirm root causes, quantify the full-year impact, and update assumptions when necessary. Finally, I would present concise commentary, risks, owners, and recommended actions to management. In your answer, cover actual versus budget and forecast comparisons, materiality thresholds, volume price mix decomposition, root cause discussions, ownership, timing effects, and documented corrective actions. Question 7. How would you build a rolling forecast? I would establish a consistent horizon, such as the current year plus the next 4 quarters. Each month, I would replace the oldest forecast period with actual results, refresh operating drivers, and roll the horizon forward. Inputs would come from accountable business owners, while I would challenge unsupported assumptions and maintain version control. I would also show the change from the previous forecast and highlight risks, opportunities, and confidence levels. Make sure to discuss forecast horizons, actual period replacement, driver-based assumptions, ownership, monthly refreshes, scenario ranges, version control, and communicating changes from the prior forecast. Question 8. How would you forecast revenue for a subscription-based business? I would use a driver-based model beginning with opening subscribers, gross additions, disconnects, and ending subscribers. Average subscribers multiplied by monthly ARPU provides a transparent revenue foundation, with separate assumptions for products, promotions, seasonality, and customer cohorts. I would reconcile the model to historical general ledger revenue, investigate unexplained differences, and obtain commercial input on planned pricing or campaigns. This approach makes forecast changes traceable and easier to explain. Discuss beginning subscribers, additions, disconnects, average subscribers, ARPU, product segmentation, promotions, seasonality, cohort behavior, and reconciling the operational model to the general ledger. Question 9. How would you distinguish operating expenses from capital expenditures? Operating expenses support the current period and flow through the income statement, while capital expenditures create an asset expected to benefit future periods. For example, routine service costs would generally be operating expenses, whereas qualifying network equipment may be capitalized and depreciated. I would follow accounting policy, verify project scope and approvals, and assess timing. The classification affects EBITDA and near-term earnings, although both categories ultimately influence cash flow and investment decisions. Be sure to explain expense recognition versus capitalization, useful life benefits, depreciation, project approval, accounting policy, cash impact, and why classification affects EBITDA, earnings, and free cash flow. Question 10. How would you forecast free cash flow for DISH? I would start with EBITDA and convert it to cash by modeling working capital movements, cash taxes, interest, restructuring payments, and other non-operating items. I would separately forecast capital expenditures, including network deployment, equipment, and other approved investments. Timing matters, so I would phase monthly cash flows rather than rely only on annual totals. Finally, I would reconcile the result to opening cash and debt needs, then stress test liquidity under downside cases. Focus on EBITDA, working capital, cash taxes, interest, capital expenditures, spectrum or network investments, restructuring, timing, and reconciling forecast cash flow with liquidity requirements. Question 11. Describe a scenario analysis you would prepare for a major network investment. I would create base, upside, and downside cases around deployment timing, capital spending, subscriber adoption, ARPU, and network operating costs. The model would show incremental revenue, EBITDA, cash burn, and cumulative investment by period. I would calculate payback and sensitivity to slower adoption or higher costs, then identify the assumptions that matter most. Management could use the analysis to set investment gates, monitor milestones, and adjust deployment before value is impaired. In your answer, cover base, upside, and downside cases, subscriber adoption, capital spending, operating costs, timing, cash burn, return metrics, sensitivities, and decision thresholds. Question 12. What would you do if operational data did not reconcile to the general ledger? I would not force the numbers to agree. First, I would confirm definitions, reporting dates, customer populations, and whether one source reflects gross or net activity. Then I would trace the data from the operational system through interfaces, mapping, and general ledger aggregation, testing samples and totals. I would involve accounting and the business owner, document any approved adjustment, and identify a control or process improvement so the discrepancy does not repeat. Mention confirming definitions and periods, tracing source systems, checking interfaces and aggregation, reconciling populations, involving accounting and operations, documenting adjustments, and preventing recurrence. Question 13. Which Excel techniques are most useful in FP&A? I use Excel to make analysis accurate, transparent, and repeatable. Useful tools include SUMIFs, XLOOKUP, index match, pivot tables, scenario switches, data validation, and clear input-output separation. For larger files, I use Power Query or structured tables to reduce manual work. I also build checks for completeness, balance totals to source reports, and document assumptions. A strong model should let another analyst understand, audit, and update it efficiently. Be sure to discuss structured models, SUMIFs, XLOOKUP, index match, pivot tables, charts, scenario controls, error checks, Power Query, documentation, and balancing automation with reviewability. Question 14. How would SQL or business intelligence tools improve your FP&A work? SQL and BI tools can make recurring reporting faster and more reliable. I would use SQL to join subscriber, billing, product, and financial tables, applying documented definitions and filters. I would validate row counts, totals, and sample records before publishing results. A dashboard could then show revenue, churn, ARPU, EBITDA, and forecast variance with drill-down capability. I would still retain human review because automation improves processing, not judgment. Focus on automating data extraction, joining operational and financial tables, validating results, reducing manual errors, creating repeatable dashboards, and preserving business definitions across reporting tools. Question 15. Tell me about a time you had to partner with a non-finance team. In a prior project, sales and finance disagreed about a revenue forecast because each team used different assumptions. I brought both sides together, mapped the calculation from customer activity to reported revenue, and separated confirmed pipeline from aspirational opportunities. We agreed on common definitions, documented ownership, and created a weekly tracker. The revised forecast was more credible, and the sales team gained visibility into which actions would close the gap. While answering, use a clear situation action result structure, demonstrate curiosity about operating drivers, translate finance into business language, resolve disagreement professionally, and quantify the outcome. Question 16. How would you communicate an unfavorable forecast change to senior management? I would lead with the headline, the expected impact, timing, and primary cause. Then I would distinguish confirmed facts from assumptions, quantify the effect on revenue, EBITDA, cash flow, or key KPIs, and compare it with the prior forecast. I would present practical mitigation options, their expected benefit, and remaining uncertainty. My tone would be direct and constructive. Leadership needs early visibility and choices, not a delayed or softened message. Discuss leading with the conclusion, quantifying the impact, explaining root causes, separating facts from assumptions, presenting mitigations, showing confidence levels, and avoiding defensive or overly technical language. Question 17. How do you prioritize multiple urgent FP&A requests? I prioritize requests by decision impact, deadline, risk, and effort. A liquidity question or executive forecast issue would generally outrank a lower value presentation enhancement. I clarify the required output, identify dependencies, estimate timing, and confirm trade-offs with stakeholders. I protect critical close and forecast deliverables by using templates, automation, and time blocks. If priorities conflict, I communicate early, propose sequencing, and avoid silently sacrificing quality. Make sure to cover business impact, decision deadlines, data availability, dependencies, effort, stakeholder alignment, transparent trade-offs, and protecting recurring close and forecasting responsibilities. Question 18. How does the accounting close affect FP&A forecasting? The close provides the actual baseline for forecasting, but reported results may include accruals, reclasses, estimates, or one-time items. I would understand the accounting entry and underlying economics before treating a variance as a trend. For example, a late programming accrual may shift expense between months without changing the full-year outlook. Close partnership helps FP&A improve forecast accuracy, explain results consistently, and avoid carrying temporary accounting noise into future assumptions. In your answer, explain accruals, reclassifications, close timing, actual versus estimate comparisons, accounting partnership, recurring versus one-time items, and updating forecasts only after understanding the economics. Question 19. What KPIs would you include in a DISH FP&A dashboard? I would design the dashboard around decisions, not just data. Core measures could include revenue, EBITDA, free cash flow, CapEx, subscribers, gross additions, churn, ARPU, wireless net additions, and forecast variance. I would show actual, budget, prior forecast, and trend views, segmented by product or channel where useful. Each KPI should have a clear definition, owner, and action threshold, so management can move from identifying a problem to addressing it. Be sure to mention financial and operational measures, including revenue, EBITDA, cash flow, subscribers, churn, ARPU, additions, CapEx, forecast variance, and useful segmentation by product or channel. Question 20. Why do you want to work in FP&A at DISH? DISH interests me because communications businesses combine recurring customer economics with substantial technology and network investment. That creates meaningful FP&A questions around churn, ARPU, growth, capital allocation, and cash generation. I would enjoy working across finance, commercial, and network teams while building disciplined forecasts and clear performance analysis. My strengths in Excel, data validation, and concise communication would help leaders understand trade-offs and make better operating decisions. Focus on the appeal of a data-rich, operationally complex communications business, the link between subscriber economics and investment decisions, cross-functional learning, and your specific analytical contribution. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.